Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. And I'm joined by my co-host, Justin Williams. Justin, we're going to talk about the latest news around oil and gas and mineral rights and royalties for August of 2023, and pretty wide variety of articles that popped up in the newsfeed this month.
It sure is. They're kind of all over the place. And this first article that we have here, it's interesting to see this because in Colorado, everyone's been talking about evaluations of property rights. And this first story here is talking about evaluation of mineral rights in West Virginia. But this just seems to be one of the topics of 2023 here.
Yeah, and I know, certainly I saw this with our house. We got the notice of valuation and we protested that unsuccessfully. But, with the prices skyrocketing in residential real estate over the past 3 years since the pandemic, we're starting to feel that in our pocketbooks as far as the tax bills going up because they usually look like 2 years back. And with those prices finally having gone up significantly now with the recent appraisals, that has certainly been an issue. And then with minerals and royalties, it's the same situation because of the oil prices and gas prices that were so high in 2022. Now that's trickling into the tax assessments. And I think people are pretty unhappy about it.
Absolutely. It's one of those costs that comes up. And if it ends up being more than expected, it's something that people can struggle to budget for if they're not listening to the news or staying up on it. And we have an article here that kind of talks about what's going on in West Virginia. And in West Virginia, the legislature in 2021 passed a House Bill 2581, and it tasked the State Department with creating a new methodology for evaluating mineral rights. This was necessary after the West Virginia Supreme Court ruled prior evaluation method unconstitutional. And so Matt, they went on and the tax department work was completed last year. And earlier this year, mineral rights owners began receiving those notices of increases in their values. And when the state tax department finally shared just how it was determining the values, it became clear that most of the evaluations were wrong. And it sounds like it just has really made a mess that the West Virginia is working through right now.
Yeah, that's pretty bad that they were found to be incorrect before and they still couldn't get it right. And of course, they were trying to get those appraisals fixed before those tax bills went out. But from anecdotal evidence, according to the author of this article, they say, quote, from discussions with local residents, state lawmakers, and county assessors, it appears that didn't fully happen. When some local residents we've heard from received their property tax bill in the mail late last week, the inaccurate values the state initially set remained unchanged. Others say theirs was fixed. So, Justin, I think this is a good reminder. This time of year, we get those notice evaluations, we get the appraised value and what our updated tax bill is going to be for the next year. And that's the time when you need to pay attention to that notice because there are usually timelines on there that you need to protest by. And if you don't follow that timeline, you're basically losing your right to protest for that year and you're going to have to pay the taxes and then try again the next year. And so I think this is a good reminder. Just obviously that window's passed for most people. I think most of those notices went out like late June and you had around till mid-July, I believe, at least in Colorado, and Texas, I believe, is the same. So yeah, that time frame, the first half of the year when you can kind of take care of that. But it's just a good reminder that next time you get the assessment is to double check that. And if you feel that it's incorrect, the value is too high, your tax bill is too high relative to your current royalties and current production, then that's a good time to protest that. And, it's something where, especially in 2022, we saw record high prices. The values that were set were likely based on that. And so they're incentivized to try to make those values as high as possible to generate more tax revenue. And to the extent that they locked in those prices as the basis for valuing the assets at that point, that's going to overvalue it based on today's prices. And then also, if you had new wells that just came online in 2022, for example, that were horizontal wells, we see the decline rates are very steep in the first year. And so if they're basing the value on those high initial production rates and depending on how they forecast those wells, they could be overvaluing your property. So that's an important trigger as well to look at. Hey, has my production dropped, by 70% since last year? And am I still paying the same tax bill that I did when the production was that high? And when prices were high, maybe it's a time to protest and you might have a chance of being successful. So I know that it's a tricky balancing act. It gets sort of into the technical realm with what we do at my company, forecasting wells, providing appraisals for mineral and royalty owners and investors. And that's definitely something where you have to have some expertise and knowledge to go and forecast those wells accurately. They have so many properties. How are they actually going about doing that within that county? That's a question to ask. We talk about that in a little more detail when we interviewed Jarrett Kitch back in episode 128. Jarrett works for a county tax assessor and is responsible for the minerals and royalties, and kind of gives a little bit of insight on how they go about determining value. And so that's involving experts and performing those types of analyses. But not every county is that thorough. So it's something to keep in mind.
Absolutely, man. You said it, and it's interesting. You would think that there would be a very standardized way they go about evaluating these properties, but it can certainly vary from state to state and even county to county. So it's certainly something to kind of keep up with and look at. And I know my method of that is I always compare it to previous taxes, and you're able to see those major increases then if you do that.
Yeah, that's a great tip. Do you want to go ahead and read the next article?
Let's do it, Matt. So the article here is about oil and gas merger activity surging after a dominant first quarter. M&A activity in the U.S. upstream oil and gas industry roared back in the second quarter following a slow first quarter, per a new report from Enverus Intelligence Research, a subsidiary of Enverus. After totaling just $8 billion in Q1 of 2023, M&A transactions cited by EIR during Q2 came to triple that number, accompanied by a revived focus on the acquisition of drilling positions in the prolific Permian Basin of West Texas and then southeastern New Mexico. Matt, and this is something we've been talking about, that activity just really seems to be shifting towards proven assets with infrastructure where they know they can make returns.
That's a key point, I think, that you just made, because as companies are looking at how do I secure more acreage to drill new wells, if I'm looking at maximizing my returns, I want to go to the best rock. And really, when you think about the size of the Permian Basin, there's so many places where there are multiple benches that they can drill that are, break even prices that are below $50 a barrel, which according to Enverus, they classify that as a tier one location or tier one acreage, which is what companies are all looking for still. And, as things are getting drilled out and leasehold positions are limited now, they're expanding their footprint into those kind of wider areas, outside of the core of like the Delaware Basin, like what this article is focusing on, and the Midland Basin. And so they're looking at how do we go to these areas that, historically maybe have only tapped into one of those benches. Let's go in and explore and develop those deeper benches. And they're finding that they can be successful in doing that in a larger area than was originally thought. And interesting, when you look at the top 5 upstream deals of the second quarter of 2023, the first there was actually a DJ Basin acquisition, and that was Chevron's acquisition of PDC Energy in the DJ Basin in Colorado. That deal was valued at $7.6 billion. And according to Enverus, that PDC portfolio is filled with tier one prospects as well, despite the majority of its acreage being outside the Permian. So it's not just the Permian Basin where this is the case, where they're looking for that kind of sweet spot acreage. But, interesting, if you look at the other acquisitions, they're primarily Midland and Delaware Basin focused, Justin.
Yep, you said it, Matt. And again, looking for that acreage where they know they can make those returns. One of the interesting stories we're seeing in the Permian Basin is that there's locations there based on existing wells and proven results. And then there's the locations that no one has tried that on bench in that area yet. So geologically, it looks like it has a lot of potential. And, I think that's why some of these buyers are moving towards the margins of the basin. And so it'll be interesting to see if this continues, Matt. And, I think in West Texas, there was a period of time where the area was just so hot that the demand was causing prices to increase on drilling wells and all of the field services. And that's probably coming down some now. And so it's becoming more advantageous for them to go back into that area, because we were seeing a lot of operators going into New Mexico or other areas because it was just so expensive to either acquire the acreage in that area, lease that area up, so on and so forth.
Yeah, that's a great point. I think that is something where it's cooling. We see inflation pressures on these costs for drilling, completing, operating these wells coming down a little bit. And then also, if you think about the prices compared to last year, they're still very strong at, near $80 a barrel, even though they're down a bit today. Actually, as we're recording this, it's still in the upper 70s, which is a great place to be for operators. They can still make a lot of money drilling new wells at those prices. But compared to $110 a barrel or even higher, it's certainly down. And if you're thinking about, if I'm looking at the current strip prices, NYMEX strip price for WTI and for Henry Hub, if they're valuing this acreage on the latest strip prices as of the summer of 2023, it's down significantly compared to where we were a year ago. So it just makes sense that companies are starting to look again at mergers and acquisitions as a way to expand their company to grow, as opposed to organic growth and leasing and that kind of thing. They can do it a little bit quicker, going after these deals that are very good in terms of the geology, the number of drilling locations, and bolt-on acquisitions for a lot of these companies that are sort of, generally speaking, adding on in areas that they're already active. But that said, Civitas was one of the buyers in the second quarter who picked up two companies in the Midland and Delaware Basin. They were actually a pure play DJ Basin operator prior to those acquisitions. And so they're expanding into the Permian as well. So they're looking to diversify a little bit. So lots of opportunity out there. I think we'll still continue to see more consolidation this year as prices sort of stay where they're at, as companies look to sort of spend some of the cash that they've generated. And I think the markets are sort of liking the idea of acquisitions as a way to grow the company.
You said it, man. And, the many earning reports have occurred now, and it seems to be the theme of the oil and gas companies that revenue continued to increase, the margin between profit kind of tightened. So it'll be interesting to see how operators focus on efficiency and that bringing that cost to drill down so that they can net more of that revenue. Our next article here is about OPEC Plus. They're not expected to alter oil production policy amid price rally. So ministers from the Organization of the Petroleum Exporting Countries and allies led by Russia, known as OPEC Plus, meet on August 4th. This panel is, quote from the article, unlikely to change the current oil production policy of the alliance at the Friday meeting, several sources in the group told Reuters on Wednesday, as prices rallied to more than a 3-month high. At the latest meeting in June, OPEC Plus decided to extend current cuts into 2024, and those cuts were originally intended to last between May and December of 23. So, Matt, that's kind of been the theme here is they want to see the price come up some.
Yeah, I think they're happy with the response from the market in terms of the price after they made those cuts in June. It's definitely provided a little bit of a floor to prices. So prices have come up since then, which they had actually breached $70 a barrel. We're down into the upper 60s for a brief period. So I think they saw the intended effect, and they're kind of waiting to see, as long as prices stay where they're at. I imagine they'll continue to keep those production cuts in place. There was an interesting twist to that, though, because Saudi Arabia made a surprise announcement in July when they announced a unilateral production cut of 1 million barrels per day for that month and going forward. So that definitely was a surprise. And, while the analysts believe that OPEC Plus is likely to keep the existing policy in place, existing cuts in place, one of the interesting quotes from that Reuters article that said the Saudi minister in July, when they made that surprise cut, said OPEC Plus would continue the effort at surprising markets. So despite the consensus that they're going to maintain those cuts, it's possible that that could change. So it'll be interesting to see what happens when they meet. I think that if they do keep the cuts in place, then that'll just provide continued support for oil prices. Especially this week, we had a surprise announcement from the EIA that we had a huge draw in crude inventories. And so that was down by 17 million barrels at the end of July. So that was a significant decline. And it just shows the demand, is continuing to be strong, and that we're continuing to use the oil that's produced. So that from a supply and demand standpoint, that's a signal to the market that demand is still strong. That should help support prices. Again, despite the drop in prices we see today, back down below $80 a barrel. But that said, I think we're, pretty comfortable in that range of the upper $70 a barrel. And I think as long as that, stays the same, it'll be, I would hope that OPEC doesn't make any knee-jerk reactions, because that could sort of unravel the market a little bit. But again, it's all based on supply and demand. And despite what OPEC says, it's really what they're actually producing. And they can say all they want about what their quotas are going to be, but at the end of the day, they're still, I believe, underperforming that. And, you have Russia deliveries down and so forth. And so that's, I think, going to help oil prices for the next several months.
You said it, Matt. And so next up and last thing here, we've got our rig count. So we're down 5 rigs for the week, Matt. And looking at where they kind of gained and lost, it was interesting that Louisiana gained 2 rigs this last week.
Yeah, it's interesting that we're seeing the land rigs continue to go down, which we suspected was going to be the case, as we're seeing, operators faced with lower profits and lower cash flow, like Justin alluded to just a minute ago. In fact, I think a lot of the earnings announcements which just wrapped up at the end of July, most of the major oil and gas companies reported profits were down significantly compared to last year, again, because of prices being lower. And so that's certainly an issue. And, if they're not generating as much cash, then they can't reinvest that into drilling new wells. And so I think we're going to continue to see that rig count go down. I think it's, been a pretty slow drawdown, which is good. It's been just a handful of rigs each week. But when you compare it to a year ago, we're down by just about 100 rigs. So I think we were at 767 a year ago. And then for this week, we're actually at 664. So, continuing in the downward direction. We still have a lot of rigs operating in the Permian. There's still 334 rigs. In fact, they picked up a rig there. Eagle Ford is the next at 55 rigs. And then you have Marcellus and Haynesville are up there as well in the 30s and 40s, Williston Basin. And then Oklahoma also has been pretty busy. And the DJ Basin, slow and steady at 14 rigs. So dropping some in Eagle Ford, dropping some in Marcellus and Utica. And then in the Barnett, they're down to no rigs running as compared to 4 last year. So like we mentioned, over the past several months, with gas prices being where they are, it's not as economic to drill for gas right now. And so it's not a surprise as probably those rig contracts came up. Those companies are laying down the rigs. They're not drilling right now at the current prices because it's not profitable to drill in most areas in these basins. And so you see, to the extent that, depending on what their takeaway capacity, what they're using the gas for, that kind of a thing, we're seeing that slow trickle downward in drilling in the gas plays primarily. But wells are getting drilled. We have a lot of rigs operating. So it's just that theme that we're seeing, kind of the new normal of slow and steady growth, just living within cash flow, not drilling as nearly as fast as we saw over the past, 3-4 years.
You said it, Matt. Operators are really showing a lot of discipline in how that they're working, and I think that was a hard lesson learned, and they're employing it.
Yeah, it's good to see the capital discipline, the financial discipline. So, stronger companies will mean that they're going to be around longer, that we're going to get, less overproduction, less underproduction. Hopefully that'll stabilize prices, and then that'll be easier for us from a forecasting future royalty standpoint. It's easier to figure out what you're going to make next year if you think that prices are going to remain pretty stable versus big booms and busts that we've seen in the past. So hopefully that'll continue to be the case. We'll keep you posted as to what happens in oil markets and gas markets and go from there. But thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.